Well, let's talk about another interesting company. MedPlus Health Services is the company on our radar. The company is on an expansion spree in FY23. They added a total of 1,074 stores. With respect to online stores, companies say that they continue to expand coverage of PIN codes for orders online. The stock's done well. I mean, late last year, stock was at about 600. It's come up to 800 now. Gangadi Madhukar Reddy is Managing Director and CEO at MedPlus Health Services, and he's joining us right now to discuss how business is doing. Mr. Reddy, good to have you with us here. Good morning. Thanks very much, Prashant, this side. I want to just start with, we have your sort of FY24 guidance numbers, revenue guidance numbers. I think you were guiding for flat margins, 20-25% growth on top line and flat margins for the full year in FY24. But with just 15 days for the first quarter left, could you tell us how is discounting looking like? I mean, is the pace of discounting coming off? I'm talking about online. What's the picture, if you can tell us?
Yeah, one would expect that with the problems being faced by a bunch of the online guys, that the discounts would actually come down. But unfortunately, it is not really true. We have at least one major competitor who is continuing to advertise the big discounts and all. So while, one of them, pharmacy, has come off a little bit, I don't think the intensity has really come down that much. So that's all I can say. I think all the journalists have been talking about the funding issues of most of these companies and the fact that, all of them have been talking about reducing the discounts. But in reality, that has not really happened, Prashant.
So what does it mean for MedPlus, sir? I mean, in that scenario, one is backed off. You're saying one competitor still persists. So where are you at in terms of discounting and sort of, being competitive, really?
No, for us, we have always been the price leaders out there. Most of the online people have actually given discounts of 25% or so on the first 3 purchases or on some special occasions. And then they try to actually drop the discount to 15 or 16, which is a viable number for most of them. So for us, though, we have always maintained the 20% discount on all bills above 1,000 and 10% below 1,000. And that's continued. So as far as a customer is concerned, if we were to strictly look at it, after the first 3 purchases in any online platform, we would be the most competitive ones. But most people, what they end up doing is after they do the first 3 or first 2 purchases on their own phone, they end up, going to their spouses or children or someone else's phone. And so they exhaust that full thing in their family before they actually start thinking about someone else. And unfortunately, in the past, what has happened is by the time a person exhausts this, some other competitor comes in and says, okay, I also want to give the 25% discount. Sure. So that thing has been kind of perennial, honestly.
So, Mr. Reddy, I think the reason why Prashant has asked you about this discounting and how the intensity has gone up, etc., is because if you look at your own business as well, right? I mean, your margins for the last 8 to 10 quarters have been in that exact same range of about 6 to at best 7%. It hasn't gone beyond that. And now with this discounting going up, with this intensity, competitive intensity rising, the fear is that perhaps margins could continue to either be in that range or maybe even fall further. Is that a legitimate concern? And if not, what would the margin band look like, say, in the next 1 to 2 years?
Okay. So our thing is a function of the rapid growth which we have. We have been adding at the rate of 1,000 stores. We added 1,074 stores last year on a base of roughly around 2,700 stores. So roughly around 35% odd stores, right? So given that all these stores will take a little while to actually mature, that's been a drag on us. And given that we had actually added 750 even the year before, and that was also a 30-35% growth on the base, you actually did not see any improvement in the margins out there over the last 2 years. But and again, as an extension of that, the fact that 50% of our stores are under 2 years, and post 2 years is when we actually make the actual EBITDA. We are going to be seeing this for a while. This year also, we are looking to actually add anywhere between 800 to 1,000 stores. And so you can expect it to be a flattish kind of thing as far as the normal business goes. But, as we continue to add sales on top of the 4,500 crores, I do not expect that our other costs, which would be, let's say, we would start getting some benefits of scale. My warehousing costs will not go up in the same level, neither will my corporate costs. So we will see some benefit out there as we go forward. But the drag because of my new stores is going to be there. While online and the other discounting has affected us a little bit, it's not done so majorly because, end of the day, the complete online thing is actually less than 2 or 3% of the overall country at this point of time. So honestly, while it does take off a little bit of shine off our SSG, it is not a major factor.
Okay, Mr. Reddy, just I've been hearing you make a lot of very interesting points. Just to wrap it up first before I move on to the question, you're saying expect flattish trends on margins this year because of the, this huge impetus of new store openings. So we should expect margins to average out around the 6% mark for FY24?
Maybe slightly better, you could say, mainly because we will definitely see some scale benefits.
Okay.
But yeah, that would be the general trend.
Maybe just slightly northwards of 6%. Okay. So just a question on how you're funding this very robust store expansion. You had pretty solid operating cash flows in the fourth quarter. So what is the total quantum of cash on the books right now? What's the capex plan? Would you be borrowing? Just a debt equity profile as well, if we can get that.
Sure. See, we raised 600 crores in the IPO, and that is primarily to grow stores. It costs us around 30 lakhs a store, so which would basically mean, the last 1,074 stores would have basically taken us around 300 crores odd. So we have 285 crores in the bank. There is no debt at all in the company. This is more than enough for us to actually grow the current lot of stores. And by the time we are done with this, our internal accruals and all should basically kick in for us to start growing at the rate of 1,000 stores a year. Even if it is not, we would not mind borrowing a little bit on the working capital side. My 30 lakhs per store cost is mainly working capital. 20 lakhs of it goes towards inventory, 2 to 3 lakhs goes towards the rental advance, and 7 to 8 lakhs only goes towards the actual build out. So which means the 10 lakhs portion, which is the actual capex, that we have more than enough, accruals to take care of 1,000 store expansion. If there's a slight shortfall in the working capital, we'll borrow it, given that we don't have any debt at all right now.
Mr. Reddy, just one final question. This private label sales are currently around 14% of your sales. How much do you think it could contribute to your overall business, say 2 to 3 years down the line?
Okay, there's two components to it. One is 8%, which is medicines, which are actually the big margin drivers for us. The other is, surgical and rehabilitation kits and all, and the hair care, skincare kind of stuff. Those we actually expect to go really rapidly. That 5 or 6% portion, which is non-medicine, I can fully see it going to 10 or 12% or so as we go forward. But the medicines, though, will probably just move a little bit. Probably go from 8 to 9 or 10% at the most.
All right, Mr. Reddy, we'll leave it there, sir. Out of time, but good conversation as always. Good luck, sir, and hope to speak with you again soon. Thanks indeed. Well, the